Hi there, Andy here. Welcome to today's video. Today we're going to be talking about order execution. Whether you're using voice brokers or electronic execution, you need to make sure that you understand exactly how to place the order that you want executed. In all trading, you need to be exact. There's no room for errors. Errors will eat into your profits, or worse still, compound your losses. With regards to order execution, accuracy is paramount. If you don't get the language or the logic of your order correct, you may find your orders filled at price levels you weren't expecting. And Sod's Law says that that won't be good for your bottom line. Before you execute any order, you're going to need to know the direction of your order. Are you buying or selling? Now this may sound obvious, but you'd be amazed how many people I've seen buy when they should have sold and vice versa. After all the analysis and time you've spent, you want to execute the order right to match. Given that you get this basic part correct, you now need to think about the logic surrounding your buying and selling and how you want to execute it. The first and simplest type of execution order is a market order. It's essentially a buy or sell now at the best price available. Here you're given the instruction to execute your order at the best price level that's available in the market at the point in time that you place your order. Now, performance of different brokers does vary, and if I'm receiving price fill levels that seem off market or consistently worse than I expect to achieve from what I can see on my screens, I'll be giving the broker some grief, or ultimately taking my business elsewhere. Generally, traders will only use market orders where they can see liquidity is good. That way, they're sure that the slippage will be low and the price fill they receive will be good. Conversely, if traders know that liquidity is low, they're much more likely to use conditional orders to ensure that they aren't on the end of the bad fill level. However, in a situation where a trader has to execute an order immediately, either to enter or exit the position, a market order will be used. So, before using market orders, make sure you have an idea of the volume available on both bid and offer sides of the market, and also the size of the order you're trying to execute in relation to this. Limit orders. Here you're placing an order with a maximum price you're willing to pay to buy or a minimum price you're willing to go down to in order to sell. It gives you some protection against lack of liquidity, resulting in your order moving the market and resulting in an average price for your fills that's worse than the price at which you first started executing. It's worth being aware that placing a limit order means that you may simply not get filled for the quantity you wanted to buy or sell. If there isn't enough volume available at the price you want to pay, you simply won't get filled. Also, bear in mind, limit orders remain on the broker's book to execute until you cancel them, or the contract, in the case of futures, expires and is no longer available to trade. So don't forget you had them working in the market. Any portion of the limit order that can be matched in the market is immediately executed. So a limit order guarantees a price level, but not that a fill will take place. Buy limit orders, therefore, should be placed at or below the market, whereas sell limit orders should be placed at or above the market. Stop orders. A stop order is used to place an order at a specific level. And when the market trades at that level, the stop order becomes a market order. In other words, it's a safety net. If a price trades, I need to trade right now, either to get in or get out. A stop loss will do this for me. A sell stop must therefore be placed below the current market, otherwise it would be instantly triggered. A buy stop must therefore be placed above the current market, otherwise again it's going to be instantly triggered. They are, if you like, the opposite of limit orders. Since a stop order will always give a worse fill level than the current market price, they're there to be used when either I want to reduce a position size if a trade has gone wrong, or to add to a position size when the trade is going right. A trailing stop can be used to lock in profits. For example, if the price of the market goes up, a sell trailing stop would move up with the market price. That way the sell level of the stop continues to improve as the market rises. And then if the market drops, the sell order, which will have followed the market up as it rose, will then be triggered as the market starts to drop, locking in some of the previous price rise rather than giving it all away. Conditional orders. These are orders that are either submitted or cancelled if certain criteria are met. One cancels other, or OCO orders. These allow traders to place a whole set of logical trades together, but make sure they aren't all executed, and positions are only either entered or exited once. When one order is filled or executed, the other order in the set is cancelled. The most popular use for these types of orders are stop loss, OCO, limit, or profit taking orders. In other words, if the trader owns a position and they begin to lose money, their stop loss is executed, but it cancels their limit order to take profit as they no longer have a position left after the stop loss has been executed. Conversely, if the market had gone in the trader's favour and the limit or profit taking order is executed, their stop loss order would be cancelled, as once again they have no position remaining to stop out of should the market subsequently turn around. If the OCO construct wasn't used, the trader would have to constantly monitor what orders have been executed and cancel any unnecessary orders in the market, which in a fast-moving market could be a disastrous situation. Order sends order, or OSO order. This construct is used to automatically send new orders to the market once a trade is filled. It will consist of a primary order that sends secondary orders when the primary is filled. For example, if you had an order to buy the limit, you don't know when or if the limit order is going to be filled, and hence when or if you will end up with a position on the market. By attaching an OSO stop, OCO limit order to the primary order, you can attach a stop loss and take profit orders that only go live when the original order is filled, and subsequently cancel each other out once one has been executed, setting the other one invalid. As orders such as limit orders remain live until cancelled, it's often worthwhile placing a duration on your order. The last thing you want when sunning yourself on a beach is to find out that the market's moved and you've executed a deal from months ago that you've forgotten all about. There's a few different types of durations. Day. These orders expire at the end of the current trading day. Good till cancelled, or GTC. These orders remain live until the trader cancels them. Good till date, or GTD. These orders remain live until a certain date, often used where you know there's a significant event, there is a central bank meeting or something like that, occurring on a certain day. Immediate or cancel, or IOC orders. These require all or part of the order to be filled immediately, or the order or any unfilled parts are cancelled. Fill or kill, or FOK orders. These orders must be filled in their entirety immediately, or they're cancelled. Partial fills are not accepted. All or none. If the order cannot be filled in its entirety by the end of the trading session, it's cancelled. Partial fills again are not accepted. At the opening. The order is to be executed on the open of the trading session, at or as close to the opening price as possible. If the price means the order cannot be filled, for example if it's a limit order, the order is cancelled. At the close. The order is to be executed at or as close to the closing price as possible. Minute. Minute orders expire after a specific number of minutes have elapsed, or are only valid within a certain minute window within the day. Thanks for listening. If you found the material helpful, please subscribe. It really helps. See you next time.